Lloyd hit the... All right, here's what we're going to talk about tonight. A lot of times, you guys, I'm going to say you guys, but I'm not referring to men. I'm referring to our team in the room. You don't have to be a guy to be you guys. A lot of times, you guys will see in this room the term OI mentioned, okay? If you're relatively new in the market, you may not understand what that is or even know what that is. Even if you're in options, you may not know what that is. I do know that Lloyd gets a lot of PMs the minute I come in and start talking about an OI trade. Everybody's blowing his PM going up. What's an OI? What's an OI? OI stands for open interest, and that's what's in your options chain on your Thinkorswim platform. All right, so the first thing I want to do here is I want to show you how to get that there. All right, so if you have your Thinkorswim open, I want you to click on the trade tab, and if I get going too fast here, y'all can stop me. All right, so click on your trade tab, and in there you're going to have a list of several columns like you'll see with mine. That's all customizable by yourself to put whatever you want in there. In this particular case, I've got a delta in there on the left, a gamma, a theta, I'm not sure what the NE is. I know the next one's probably our the net change. And then I've got probability in the money, volume, open interest, high and low, bid and ask. Okay, you don't have to have all that. And for what I'm going to do tonight, I'm actually going to get rid of some of all that. So what I want you guys to do is what I'm going to do here is you'll see my options chain. I'm going to go up to the right-hand corner with the 3 little bars and the 3 little dots. And I'm going to click on that, and I'm going to detach this thing. What that's going to do, as you'll see, is it's going to open up a new one for me. Okay. What I did is I messed around with some scanners. You can do scans if you watch I got a video that I did for you guys on scanning. I did one on how to set up the platform, and then I did one on scanning. If you'll watch that video, you'll understand what I'm saying about when I'm talking about writing a scan. What I've done is I've written an open interest imbalance scanner for myself, okay? I spent a lot of time on this thing, and there's a lot of people that have tried to get it from me. It's the one thing I won't share with anybody or the room or even my best friends. They don't have it. Some things you keep to yourself in life, and that's one of them. So there's a couple things with open interest trades. One of them is understanding how to play them and why, and the other one is how to actually find them. As far as finding them, you guys will have to rely on me to do that for you. I've written the scanners that will actually find them, and then I tweak that scanner 2 or 3 different times. So I have 3 different open interest scanners for imbalances. Okay, a couple people have tried to clone them. You're not going to be able to clone it. There's some tweaks in there that are just so far out in left field that it's just not going to happen. So what I've done here now, I detached another options chain. What I'm going to do here is I'm going to click on go down where it says layout. It says delta, gamma, theta on mine. I'm going to click on that, and I'm going to go to customize. Okay, in this customize, I'm going to remove some of these things because this is a detached one. So as far as imbalances are concerned, I don't care about the delta, the theta, the gamma. It's coming out of there. Probability and the money's coming out. I want to get net change out. I'm going to leave the volume and the open interest in there. High is going to come out, low is going to come out. And now my detached options chain in toss is going to look like that. That makes this a whole lot simpler for me to quickly identify the imbalances from the open interest columns. Because as you can see on my screen now, if you slide over to the far left side in the form, slide your little bar at the middle of the page over to the right, you'll see I now have an options chain open that only has the volume, the open interest, the bid, and the ask. That's all I want to see. Okay, I don't want all the other confusion, noise going on of all the other columns while I'm trying to do this search. All right, I am going to have to move that for a second because I got to detach one more. Now, anytime you build a scanner in Thinkorswim, which I have lots of them that I've built for myself and for other people, you can create that as a market watch. Okay, I'm going to click on the market watch tab up here at the top. And it's going to show one of the 3 that I have. Okay, the first one that I have is it's a little looser scan. says open interest for weekly pin strike. The next one that I have is an open interest for weekly pin strike. It's the exact same thing, but I've tweaked it to be a little tighter and narrowed down the possibilities of potential plays so that I don't have to go through so many of them. Okay, and then this particular one that I have, the open interest for weekly pin strike number 2, this one is going to show up with stocks like, if you look in here, you'll see Apple's in here, Cisco's in here, Twitter will be in here, I can guarantee you without even looking. You know, Facebook's going to be in here. All those are going to show up in here. Okay, and in most cases, all those have imbalances in the options. And I'm going to get to what that actually is for you guys here in a little bit. So I looked at this and I said, okay, this is pretty cool. It gives me all the imbalances. But then I got to looking at it, I thought, you know, there's 60, 70 stocks in here, maybe more, 80. I don't want to have to go through that many stocks every time and have a whole list of them come up that have the Twitters and the Facebooks and stuff like that, because of something else I'm going to explain to you here in a little bit about the volume, the daily volume, and how that can potentially clean up or wash an open interest. Okay, so I went back in there again. I thought I'm going to tighten this thing up a little bit more, and I came up with my one that is an open interest for weekly pin strike number 3. And you're going to see this is going to populate a new list, and now it's narrowed down this list. What I did with this one is I told it, find me stuff that has an open interest imbalance that meets this criteria, a certain amount, and I tried to use some different stuff that I wrote in there to balance the open interest against the underlying volume of the actual stock. Okay, because if you have a big open interest in like SPY, and then you have huge open interest, huge volume for that day in SPY, and then you have huge volume in the underlying, a lot of this stuff may not actually matter. It may not do anything. However, what I did is I tightened it up so that now if you'll look at the list that's coming up now, it's narrowed it down to stocks that do not necessarily have huge underlying volume that can potentially fix the actual open interest imbalance. And that's when I decided, okay, now I have the actual scanner that I want, because now, as you can see, it only shows about 15 or 20. So these are real easy for me to go through. All right, so this is simple stuff for me to go through now and come up with some plays for the room. There's several criteria that I need met with these things, and I understand a lot of the stuff, how it works. So before I toss one in the room, I actually do quite a bit of homework to it before you guys actually see it. Because obviously I want to get the room in number one, trades that the risk reward is really good on, trades that the potential for it or probability for it to work is really high on, and number 3, the cost is really low to enter on it. Okay, so I'm going to go over here now again to my trade tab. Actually, what I'm going to do here, let me go back to my market watch. I'm going to detach that list. What I'm doing, you guys don't have to do this. I'm going to detach that list real quick and move it over here. All right, I'm going to narrow it down. So now what I've done is I've taken the list of ticker symbols that it populated on the tightest one that I have, which is the open interest pin strike for number 3, and it's eliminated the stocks like Apple and SPY or Tesla and stuff like that the volume can actually clean up or wash out the open interest. So now we have a group of things here that have a little more potential. All right, now I'm going to go back on this thing to my trade tab. Wait a minute, okay. I'm going to go through when I go through the list and we look for some candidates, I'm going to put this one back up that actually only shows the volume and the open interest. Okay, but for now, I'm going to go back and get rid of that thing. I don't think I do maybe want to see some of these other columns. So let me go and pick out the one that I put in there in the room today, PFE. All right, here's PFE. It's Pfizer Corporation. A couple of basic rules with plain open interest trades. Okay, when you see someone discussing OI in the room, they're referring to open interest. If it's something that I have said or something that I brought to the room or something that another member or another moderator is saying, hey, what's Moto's OI trade? If my name is attached to it, it will always have an imbalance of some sort to it. Okay, I'm going to explain to you what an imbalance is. Anybody got any question on that? Because everybody blows up Lloyd's PM and asks him, what's an OI trade? What's an imbalance? I mean, you guys at least know what an OI trade is now. We're good there. All right, I got Pfizer open here. What we want to look at here? I played this one a little different. I'll tell you why. There's a couple of basic rules behind the open interest trades that I play. I do a lot of things in the stock market. I trade futures. I trade ES futures. I trade NQ futures, YM futures. I trade options. I do not trade options on futures, but I do trade a lot of options. I do a lot of different option strategies where I may play a butterfly strategy. I may play a credit spread. Like I did two or three of them on Apple last week. I may trade some stock and sell covered calls on it. There's a lot of stuff that I do. None of this is how I generate my income. I own companies, and that's how I generate my income. I play the stock market for fun, and I try to stay really involved in it because I understand and know a lot of stuff in the market, and I want to keep myself fresh all the time. So that's why I'm constantly, attacking the market because I don't want to get rusty with it. There's a couple of basic rules that I keep in place with my open interest trades. The number one rule, and you'll see me always say it in here, and I even step so low as to say please to you guys, play them small, okay? Play them small. Yes, we've had a bunch of them work, okay? We've been running about 70, 80%. I haven't tracked in a while because we haven't done a whole lot of them. Well, we've done some, but not a lot. We're normally running about 70, 80% success rate on it, which is pretty good. I can't complain about that. But again, like I said, it's the smallest part of trading that I actually do. It's these open interest trades. So when I share something with the room with you guys, it's more to benefit the room so much than it is for me because it's a small part of what I trade. So the rule, that first rule then is in place with me in that play them small. Don't look at it as a lot of Moto's plays actually work, so I'm gonna take a big hit at this one. I'm gonna do 100 contracts. Don't do it. Just don't do it. Do not. I said don't. Poor English. Do not do it. It's not worth it. What we try to accomplish here is we try to play them small for a big win. We want a big win out of it. All of us will take the big win, but don't play it big to get a bigger win. Just play them small. Very important rule. Okay? Next rule. I get to ask this one all the time. All the time. Do you put stops? Do you set stops? Well, if I do an open interest trade on Wednesday, which is today, and technically it's not supposed to work until Friday, then why would I challenge its ability to work on Wednesday afternoon, an hour after I got in it, or on Thursday morning, or even on Thursday afternoon? I haven't given it the time it needs to run its course to actually be a winning trade as an open interest imbalance. And I want you guys to understand that. I don't put stops on them. You know why I don't put stops on them? Because I'm trading an amount that I'm willing to risk and lose 100%. That's how I go into it. My range on these things is 50 to 100 bucks. Okay? I've turned $50 into $400 several times, $500. We had a BABA trade. We turned $50 or $100 into a $1,400, $1,000. That's what I'm after. So I don't look at it as, well, I'm usually pretty right on these things. I'm going to put, $3,000 in one and see if I can turn it into 40,000. I don't do that because you're not guaranteed anything in this stock market, and I'm not willing to risk that much, even though it has a technical reason to actually work. Like I said, it's the smallest part of trading that I do in the market of anything I do, and it's these open interest imbalances. And I like sharing them with the room because it allows the room to get in on small trades and risk a small amount and have a high reward for it. I watch what's going on. Okay, I got a big system that I trade off, and I can have 16 screens open at any time. That's why not much gets past me. Even though I'm busy, I'm always keeping an eye on what's going on, what's being talked about, what's going on in the room. I back check some things to see if the truth is being told. And a few guys have found out that I'll call you out. If you're lying, I'll call you out. It's just the way it is. The room is based on value, and there's a ton of value in this room, not just from moderators, but from members also. And we want to see it stay that way. That's how you keep the room numbers up when there's room value. This thing was started a year ago, and a few of us got together, and now the thing's built up to a big thing. Lloyd's done a really good job with it. So it's important to us that that value maintains itself in there. So back to the rules. Rule number one, play them small. Rule number two, don't ask me because I do not use a stop. I give the play the entire course to run, and it either works or it does not work. What does that mean? That means I'm taking the potential risk of losing 100% of that trade, and I'm okay with that. Why? Because I'm within my risk tolerance. If I'm in that $50 to $100 range, I don't care if it doesn't work. Obviously, I'd love to see them work, but if it doesn't, I don't care. So that's your call. If you put up $50 and you feel like that's your risk, but all of a sudden $25 of it is gone 30 minutes later, you may want to stop out. If you can't stomach it, if you got too much emotion in the game, too much emotion in that trade, it's a combination of many things it could be. If any of those are involved, don't play these trades because, as you can see, we got a little bit of a hit today before this thing actually worked, especially on Johnson & Johnson. Everybody was interesting. I got in when I first brought that one. I usually throw these at Lloyd. A couple other people, I'll throw them at Leonard sometimes. They get to see this stuff a little bit before you guys do. I want them to look it over and see what's involved in it before I toss it in the room. And there's another thing. A lot of you guys, as soon as I put a trade out, all of a sudden Lloyd's PM box gets blown up. He got like 30 or 35 of them today. Are you taking Moto's trade? Are you taking Moto's trade? Okay, now think about this. Lloyd runs a room. He's busier than heck all the time. He's constantly doing stuff to keep the value of the room up. He's trading ES futures. He's trading this stock. He's trading out. He's busier than heck. And all of a sudden he gets inundated with 30 to 35 PMs from people or members asking him, are you going to take Moto's trade? Okay, well now if your risk tolerance is $50, and I know Lloyd's is much higher than that, why would anybody have to ask Lloyd if he's going to risk $50 on one of my trades? So do me a favor. These are decisions you make. Lloyd doesn't make them for you. And Lloyd's not going to advise you based on previous success that we've had with the open interest trades. So do me a favor. Don't ask him. Don't bother him. If he decides to take it, he'll do that on his own. You decide on your own also. If you have a risk tolerance of $50, then take the trade. You don't need anybody else to bless that for you. And if you understand the trade, then you're even a little further ahead of all the other ones in here that don't even understand why they're taking the trade, nor want to take the time to actually learn it. I'm going to go through it here in a little bit and show you guys how I came up with this one and why. So again, trade your own plan. Don't trade my plan. Don't trade Lloyd's plan. All we're doing is trying to add value and give trades into the room that you guys can take a look at and maybe say, that trade makes sense. We both got a lot of experience in this, so we're more likely to find things that do make sense. But you still have to do your own homework and say, is that a trade I want? And we'll always take feedback. And so whenever somebody comes in and says, hey, Moto, on your such and such trade, that looks great. However, they're doing such and such in a week, or they're going to get approval on something, or because I don't do a whole lot of homework on the companies. Quite frankly, I don't care who the company is, and some of these things will play on companies we've never even heard of. I've never even heard of. The company means nothing to me. The fundamentals mean nothing to me on open interest imbalances. And quite frankly, oftentimes the chart means nothing to me other than the fact that I want to see that the stock is really topped out or something. That I want to see, or really bottomed out if we're going to be playing the other side for the imbalance. So again, you guys decide what your own risk tolerance is, and then you decide, hey, I like this trade, or maybe do a little bit of research and find out, hey, I found this out on it, and post it in the room, share it with everybody so that, everybody's on the same page, and you can say, hey, well, J&J, I looked it up, and I found that one today, and then I posted it in the room, and then I kind of did a little homework, found out they actually did earnings yesterday. They posted them, and they beat, and they guided up well. So I'm thinking, okay, so here now we're in a bearish position on a company that beat on earnings and guided up. However, there's been other companies here that have beaten the last couple of days, and the stock's tanked. So we just never know. All right, what am I looking at on this one? This is a little different, a little more unique than what we normally would do. Normally when I do a scan, I try to find stocks that have an open interest imbalance on weeklies. They are more likely to fix those because if it's a really big one, and in the past we've found some really big open interest imbalances on the weekly expirations. Those get fixed quite often. They're also much harder to find now. I don't know if it's because volatility's down or up, or interest is kind of faded, or I'm not exactly sure what has happened, but I'm not getting ones that show up on the weeklies like I used to. I used to get them all the time. There'd be tons, massive amounts of volume and open interest going on the options chains on a weekly. It just doesn't come up anymore. I do realize that I have to run my scan, and I probably, based on the criteria that has to be met, probably will not get any results until Monday or Tuesday. It usually takes a few days into the week before the volume requirement that I've built into my scanner actually gets met, and we start to see the imbalances coming in. So oftentimes, if you guys are looking to play these, it may be Monday, Tuesday before I even toss one out, sometimes even Wednesday, because that's when they show up in my scanner and they actually become an imbalance. I haven't been able to get hardly any that show up on a weekly basis for weekly expirations. A little disappointing. I'd rather play those. But I do get them on the monthly, and that's what you're looking at on the right-hand side here. So what did I see on PFE? All right, open interest imbalance, okay? Let's go back. Does everybody have the open interest column? If you do not, go into where it says layout on the top of your page. I'm going to show you how to put that in there. I'm going to go to my other screen here real quick, put this back. Oh, I didn't want to do the whole thing. All right, if you go into, on your options chain, where it says layout, click on that, and go down to about the fourth one from the bottom where it says customize. And you'll see I detached this from my regular one, my regular options chain, and this one now only has volume and open interest in it. If you'll slide the bar down on the left side, about 3/4 of the way, you'll see one that says open interest. Double click on that. Okay, what this is going to do is it's going to create that column for you in your options chain. Some of you guys may be asking, what's open interest? What's an OI trade? What's this? And some of you guys may be asking, what's open interest? What's an OI trade? What's this? And a lot of that you may be left in the dark on because you don't even have the column in your listings here, and you have no idea what we're even looking at. So I want to show you how to actually get that in there so you do have it. Is anybody not following me there? Then if you hit OK, you're going to have that. So anybody not catch that? Everybody fall asleep and nobody's even saying anything. I don't know if that's respectful out of the fact that I'm giving a class or if everybody went sound asleep. Does anybody not have the open interest column in their option chain? No, I'm not stopping. Sometimes there's a couple ways you can look at these classes. If nobody says anything, it's because you're covering everything correctly or they're either bored and fell asleep. So you just got to accept it's one or the other. All right, I just want to make sure everybody has the open interest column in their options chain. You can see it on mine. So what did I look at here? This one came up on my scanner. And interestingly enough, sometimes these things don't come up on like a Monday when they should have. And I've yet to figure out exactly why that works like it has in that scanner. But with all this open interest in this PFE, this one should have been here a little while ago. It's being recorded, so you're good. We're talking about the open interest imbalances. That's right, Shaquille. But it is being recorded, so if you're late or you aren't even here, you'll still get to watch it. All right, if you have Thinkorswim, you're going to see an area that this makes it real easy to recognize this stuff. You're going to see an area that is shaded kind of a lighter gray color. I'm circling it here. You'll see that what I have open here is I've got the weeklies and the monthlies. Okay, if I just looked at this thing from a weekly standpoint, in the gray shaded area, it's going to show the area of options that are trading to the current trading price. On the call side, it's showing up to 33. Once it goes above 33.50, if it does, then it's going to include that line into the gray shaded area. But right now, it's right here where I just drew the blue line. Okay, on the put side, same gray shaded area. Once it drops below 33.50 and then down to, the next 33 strike comes into play, that one will get shaded. But right now it's not on the put side. So there's my two blue lines. Now, you're asking where's the imbalance? Okay, in this particular case, on a weeklies, this has an imbalance, but it's not enough that I would get that excited about. And also, by the way, I picked up on this one on my open interest imbalance strike number 2. The one that is the scanner that is set a little looser is one that this showed up on. Sometimes if it shows that 80, 90 stocks, if I'm feeling really energetic, I'll scan through all of them and see what it looks like. This one did not show up on the left side of your screen. If you look at it, that shows my open interest imbalance number 3. That's a tighter one. The reason this one wouldn't have shown up in there is because of this underlying daily volume of 35 million. Okay, it's not looking for those types of imbalances where that underlying volume is so high relative to the options, the open interest in the volume. Okay, so let's look at the weekly. It still has a little bit of an imbalance. When we say imbalance, if you'll look over here on the call side, you'll see on the 30 strike there's 595. There's 1,189 on the 30-50. There's 2,241 on the 31, and so on. Okay, all the way up to the 33. There's a bunch of open interest. Open interest is what is still on the table. That is a combination of multiple different types of option trades that can be anything from buying puts to buying calls to selling calls to butterflies to whatever trade it is that your heart desires. If you keep that trade open, you will be an active participant in the open interest that is on the table, and it will be showing up in there on that strike of whatever play you have. That stuff continues to build and deplete itself each day. However, we don't get to see it until the following day. So in this particular case, if you look at the 3250 strike calls, there's 1,149 open interest that's still on the table. So the combination of several plays that are out there that are still open are in that open interest. And you can look at the volume and see that 125 came in today. We have no way of knowing if that's going to be added or subtracted from that open interest. It's one of the things they keep us in the dark on. We can see tomorrow. We can look at it tomorrow and say, okay, the volume changes during the day, throughout the course of the day. As the volume is changing, if you were to buy, 10 call contracts of a 3250 strike call on PFE, it would show up and that 125 would go to 135. Okay? If at the end of the day you sold those, then nothing is going to be added from your standpoint to the open interest by tomorrow morning. So anything that comes back off the table is not going to go back in the open interest the next day. However, let's say that entire 125 is actually purchases that are going to stay on the table. Well, then tomorrow that strike will open with 1,274 on the open interest. Everything that came in was buys, and everybody decided to hang on to it overnight. That way you can see that it actually came in and stayed on the table. Now flip over to the put side. If you look at the 34 strike, or 33.50, all the way up to the 39, it's all zeros, except one 13. There's a 13 on the 34.50. That's where the imbalance comes in. The imbalance portion is there's a lot of open interest on the call side, and there's nothing on the put side. Okay, what am I looking for? Okay, let me show you. So we have a lot of, not a lot, we have way more open interest on the call side and nothing on the put side. That would then create an imbalance. So let's go out to the monthlies. I'm going to click on May, third week May, monthlies. I want you guys to look at this. All right, right here at 33 bucks where it's trading, if you'll look at my far right-hand column here, there still is nothing on the put side. There's 46 on the 33.50, 449 on the 34, 88 on the 34.50, and 194, and then there's zeros after that. So here's where we have a gross imbalance. Go over to your call side and look in the gray area, 33 strike and anything under it. I've blue lined that one. Okay, I'm going to blue line the put side. Okay, so here's what I'm looking at when I gave you guys this trade. And this one's unique in that we found out last week that a lot of the monthly expirations don't necessarily have to be corrected. They don't have to be fixed. There's so much going on in the underlying stock at 35 million in volume that we don't know where the market makers are making their money, or how they're making their money or how it correlates to the open interest on these options, and it may not correlate at all. They may just decide at the end of May, the third week of May, I mean, that they've made all their money and they could care less about the options. All right. For face value, as what we see for face value, that hasn't happened yet. Okay. One thing we did learn a week ago on a stock. If it's a ex-dividend date for a dividend that the company pays. I've been pretty good about looking for this now because we got bit twice on it. Once on I don't remember what it was, N something Q, and then once last week on one. What MAS? If it's ex-dividend day, what can happen is whoever owns these contracts can actually exercise these, and it does not show up in the volume. Okay. That kind of threw me for a loop, and I actually had a hard time finding an answer because I called Interactive Brokers. I think David in the room called his broker, and then I called some other people, and I actually had to call the options board to get an answer. And the answer is if these shares get exercised on ex-dividend day, they vanish. So all this open interest, if there's an ex-dividend day from now until the third week of May for Pfizer, all that open interest could potentially go away. It just vanishes. There is no paper trail to it. So that 50,000 you see on that 30 strike call side, if there was an ex-dividend in 2 weeks, that could go to zero. And there's no paper trail or any explanation for us retail traders as to where it went or why. And they don't have to give us one. But like I said, for face value, it's there right now. So as you can see, there's a big imbalance here. There's a whole lot of call open interest that's still on the table, and there's virtually nothing on the put side. So when we're talking in terms of an open interest imbalance, how do we trade this? Well, let's go down to the 29 strike. The stock's trading at $33.23. Let's go to the 29 strike. It has 37,420 contracts that are still open. If you take that times 100, which one contract is 100 shares, that's $3.7 million. Okay, $3.7 million. That stock is currently on that 29 call is in the money by $4.23. Okay, so that one strike by itself is $3.7 million times $4.23 of the money. What are we talking? 15? I don't have a calculator. 15 or 16 million. So that one particular strike, just that strike by itself, creates $16 million worth of in-the-money calls. Okay? Now, like I said, they can be a combination of several things. If I was doing a butterfly spread on a 29 where I sold a couple 29s and bought a 28, bought a 30, then I would be a seller of those on there. For the most part, the market makers are the sellers on these. Okay, most plays that are played, the retail traders and some of the hedge funds, they're buying options or hedging with options, and there's a lot of different things you can do, but in most cases they're being bought versus sold. Nobody's naked selling a 29 that's already in the money because it's going to get already get exercised or assigned if it's on the put side. So you don't have that going on. Does that make sense? So on that particular strike, we've got $16 million or $15 million that's in the money. So from a market maker standpoint, if they sold the majority of that or even half of that, it would be in their best interest to bring this stock down. Now, are they going to bring it down to 29 bucks? Probably not, because they're making a lot of their money in the underlying volume on this stock at 35 million shares trading a day. So they're making a bunch of money there. So they don't have to answer to us and say, hey, we're going to bring this down to 29 bucks so that you see we're actually doing our jobs right and maximizing all this stuff for everybody, because it's none of our business. We don't need to see it. They don't want us to see it. If we saw it, some of us would be smart enough to actually play against them. Let's see, blue, white, 29, 50, 30 others like this showing 0 OI. I'm not sure why they do that, why they select certain strikes over other ones. It doesn't really make a whole lot of sense, that they're using the round numbers, the 29, 30, 31s. I mean, someone else may know. It's very typical that you see it like this, though. Don't know. So I can't give a concrete answer on that. You'll see on some of these other ones we're going to go to that same thing's going on. They'll skip strikes for some reason. Not sure why they do it. But anyway, okay, so you see we got $16 million on the 29 strike. Now if you jump up to the 30 strike, it's got 50,906. Take that times 100 and you got $5 million, $5.9 million there. That 30 strike is in the money by 3, so another $16 million is sitting there. So we got $16 million in the money on the 29 strike, and another $16 million in the money on the 30 strike, and still nothing over where it's currently trading, nothing over on the put side. That could potentially offset that. There's just nothing. So just short of them making all their money in the underlying stock and not caring about the options, we have a potential reason and a technical reason for them to bring this stock down. Okay, yeah, that's old school. I didn't think about it that way. Yeah, it's old school. It was traded in whole numbers. A lot of these stocks don't even have these half point deal, half strike deals. But the ones that do, for some reason, the zero shows up on them. All right, so as far as an open interest imbalance, you guys can see the imbalance. There's nothing of any value for the most part on the put side. There is a lot of weight on the call side. Will they fix that? They could. It has a technical reason for it to fix. There's, of the 2 strikes we did the math on, there's $30 million in the money. It's equal to a day's strike. These are monthly strikes. So not a really big offset. They could probably make this fix, trading the underlying stock. So there you can see the value in the number 3 scanner that I wrote that pins this down to stocks and companies that don't necessarily have this high of underlying volume to actually fix a gross imbalance that I can find. So that puts the odds even more in our favor. I'd love to see a stock that showed up with this much imbalance on the call side and it was trading 3 million or 4 million shares a day. It'd be a home run. We know it would fix. They have to. They're not getting their money out of the underlying shares, so they have to fix this option imbalance to get themselves paid. Now, how do we play it? In this particular case, we took, normally, you guys could play a monthly. You could look, the first thing I do then is I go look at the chart. I look at PFE on the chart, and I'm like, yeah, it's kind of toppy. It's had a nice long run. It's definitely a bullish stock, so we're definitely going to be playing counter trend. We're going to be in a league all our own, the Lone Ranger on this one. But again, retail traders have a tendency to herd. They follow the herd. The little shepherd leads all these sheep, and they just, they play the trend, play what seems to look like it's the way to go, and then they just keep playing. At some point, market makers, they know this. At some point, they shift this stuff and go the other direction, and then all of a sudden everybody's caught with their pants down their knees. And if we catch one of the right ones on these things, we're on the winning side. And so when a market maker determines it's time for him to become a winner, we're hoping that we can already be in that trade and become a winner with them. And obviously we're playing counter trend doing that. So I looked at the chart, a little bit high. It did take out a resistance level of 33.08. So what my thought process is here is, okay, if we can get a weekly option expiration, and the chart's a little toppy, if they fix it a little bit and we can get into a weekly option fairly cheap, close to at the money, I'm going to take a shot at it. Okay, we're counting on a couple things. It's a little toppy. We want them to correct. We've had all these up bullish days in the market. It doesn't seem to even know what a bearish day is, but sooner or later we're going to get some. So we're buying ourselves a couple trading days that something happens. Oftentimes these bullish stocks are going to continue to be bullish if the market stays bullish. So from a weekly trading expiration standpoint, if the market stays bullish, this one's probably going to follow it because our open interest imbalance is on the monthlies, which is the 3rd week of May. So they got plenty of time to worry themselves and concern themselves with whether this stuff is fixed versus trying to buck the system and go against it with a stock like PFE if the next 2 days are nice up days in the market. It's just not going to happen. So there's one of the risks we take that's a little more involved in trading a weekly option against a monthly imbalance. They have some time to fix it. So in this particular case, I still said, okay, on the weeklies, we still have a little bit of call imbalance versus the put side. On the monthlies, we definitely have a huge imbalance versus the put side. Let's see if we can get a trade fairly cheap, and then we went with the 33 strike, okay? It was 8 cents and 10 cents. I filled at 8. My total cost was 9 with the commissions, so I'm in them for 9 cents. So I filled it at 8 cents. I think I did 5 contracts. I did 3 or 4 today, so I got to look. But I probably did 5 contracts, so I had $40 at risk, okay? Am I going to put a stop on $40? No. Why would I? What am I going to try to salvage 20? Come on. I did see someone, I'm not pointing anybody out, pointing fingers, but I did see somebody that say they stopped out or got out or one reason or the other when it dropped down to like 5 or 6. And it kind of irritated me. And I probably shouldn't take it so personally, but I've explained this stuff so many times in the room. Everybody in here should know by now that I don't put stops on this stuff. I actually put, and normally I won't even dollar cost average them because I'm very disciplined in my trading, and my range is 50 to 100 bucks. Well, I only had 40 in this one, so because I was still under my risk range of what I was willing to lose, I actually put another order in on the 33 strikes for 3 cents. I thought if this thing wants to just totally die, I'll take another 5 contracts at 3 cents and put a whopping $15 in. I spent more than that on dinner tonight, about 3 times that. So I put it in at 3 cents, but I never got filled. That's another game they play, and I don't know if you guys have traded enough options to pick up on this, but if you'll watch some of these things, out of nowhere, you'll see a high for the day and a low for the day. This thing plugged an 0.03 cent low of the day when the stock was at the high, okay? But it never gave us better than 5 or 6. I'm thinking, I got some funny games going on here because the best this room gave us was a 5 bid and a 6 ask, if I remember right. And all of a sudden, somehow somebody slips a 3 in there. So there's obviously some market maker games going on somewhere that we don't get to see or know, because they should not be able to fill, you would think, legally fill a option at 0.3 if we never got the same opportunity. If 5 and 6 was the best we got, where'd the 0.3 come from? And I saw it pop up today. It kind of frustrated me. But I can't fix that. But I did want to mention it. Keep an eye out. You guys will start picking up on this now that I mentioned it. You'll see that a low of a day may be 16 cents, and you're like, no, that's not 16 cents. I've been wanting to buy this thing, and the lowest I saw was 19 cents. And then you're going to be asking in the room, well, how'd that show at 16 when that never really got there? I'm wanting to enter this stock, and the best it gave was 19, and that was on the bid, so I couldn't get it. Unless I was willing to give 20, and you're going to say, where did this 16 come from? I don't know. Don't have an explanation for it. They obviously play some games that we don't get to see. So like I said, I got a little smart aleck in the room today because I saw a couple people that freaked out because the trade went to 5 or 6 cents. And if you go back to one of the first things I said tonight is play what you can afford to lose 100% of. In my particular case on this one, it was 40 bucks. Okay? If you're one of those that comes in the room and says, oh, there's a Moto OI play, I don't really pay attention, I'm fairly new here, but I hear a lot of those things work, so I'm buying 100 contracts. Well, if you're that stupid, then I apologize for you. Pay attention. Don't buy 100 contracts unless you're willing to lose 800 bucks and watch it go down to 400 bucks, in a couple hours, in about 30 minutes actually. So in this particular case, they're blowing up the room saying, hey, I stopped out or I got out, I couldn't take any more loss. You're playing with way too much emotion. If you're actually playing these trades alongside of me, if you've played every one of my trades, you're miles ahead of the game, miles ahead. We've had winners that were big enough, and so many of them, that the losers, even though there's a stigma that goes along with the phrase, I lost 100%. Well, if my 100% was 40 bucks, along with the phrase, I lost 100%. Well, if my 100% was 40 bucks, I don't care if I lose 100%. It's the ones that we make 800 to 1,000% on that count, because they pay for about 15 trades that lose 100%. So when I start seeing people and Lloyd says, oh, they're blowing up my PM and stuff, are you going to buy this trade? Are you going to take Moto's trade? Don't do that. Don't blow up his. Don't blow up mine. And if you want to stop out at a $20 loss, then you don't need to be playing these things because you've got way too much emotion in the game and you're getting involved in a trade that can very easily. I mean, if I was as good enough to perfectly pick these things at the bottom, we'd be killing it. If I would have waited until 5 or 6 cents. However, at 8 cents, I felt like it was a fair value deal for me. I bought 5 contracts at 8 cents and got $40 in there. Way under my risk tolerance, but I'm willing to hang it out there and don't care. All right, so how's the thing going to work? Okay, well, if they drop it to, let's say they drop it to 32.50 tomorrow. All right, for some reason, let's say we don't know, we don't have a way to know, but there is the likelihood that if we get a down market day tomorrow, a lot of these big companies like this are going to follow. Okay, so let's say we do get one tomorrow, and we got all that open interest on the call side that's imbalanced, and they decide, yeah, we can bring this thing down a little bit, even if they brought it down to 32.50. Our trade is then worth 50 cents because it's in the money 50 cents. With the premium inflation that will still be in there tomorrow, that's probably going to be worth maybe 55 or 58 cents. Okay, so we've turned an 8-cent trade, if it drops to 32.50, down to 55 or 56 cents. So that's almost 1,000, or no, it's not 1,000%, but that's what, about 600%, 600%. So all we need to do with this thing, if you'll look at today's low, it was 32.85. Okay, if it just went back to today's low, again, if the market's up tomorrow, it's probably not going to. If the market's down tomorrow, there's a really good likelihood this thing could easily go to 32.85. Then we're at 15 cents plus a little bit of premium, or which probably is going to put us at about 19 or 20 cents. Well, now we've gotten 150% winner overnight. So we risked $40 and we have 150% winner if it goes to today's low again. Let's say it does go to 32.50. If it goes to 32.50, it's now worth 50 cents and you have 5 contracts, so that's $250. So because I'm disciplined and my risk reward, my risk tolerance is, within the tolerance of $40, if this thing drops to 32.50, then I can cash in a $40 investment for $250 in a couple days. That's the key to these things. If we get 5, 6, 7 in a row that win, don't just assume if Moto puts one in the room, they win, because they don't all win. But as you can see, if it doesn't, I don't care. I'm down $40. The next one may make me $250, $350, $400, $600. I can be down an awful lot of $40 ones before I start losing if I make 500 or 600 on one of them, as you can see. All right, now, any questions so far? You can hit me up now. I haven't even been reading the room. We're on to 9. Let's see, what reward are you looking for? See, there's another question. What reward are you looking for? That's, I gave the first 3 sets of rules. My next rule in trading open interest plays, and it's only because you have to be really disciplined, and it's also because, I'm not going to lie, I have had some winning ones turn to losing ones. And there's nothing more frustrating. It's hard enough to make money in the stock market. Nothing more frustrating than allowing yourself to take a nice winning trade and let it actually go against you and become a losing trade. So one of the rules I put in place for myself personally is if it makes me 100% in a day, I'll take it. Okay. The other ones that we made bigger money, they've made us 5, 6, 7, 800% in one day, and I've taken those. If I make 100% on a trade, I'll take that trade and close it. Okay. Even though it still has potential for more. I learned a little more lesson last week and got a little slapped again and came to the realization that even though the structure is still in place and it all makes sense, the imbalance is still there, that doesn't mean it has to work. Okay, we're counter trend playing. We are playing stocks that we need to go down when everything's going up. Okay, so keep that in mind. So if I make 100%, in the day, or the day I open it up, or if tomorrow, if I make 100% on this thing, which at 8 cents, I don't know, I might break my own rules. I don't know. I'll see. Normally, if I'm in the 25, 30, 40 cent range, price range on these things, and it doubles on me, I'll take it. On 8 cents with 40 bucks on the line, I may go for a little better than 40 bucks. The other thing that will get me out of a trade is if the structure changes, okay? And on MAS, when they exercised all those call options because of the ex-dividend, all that imbalance went away. So when you you guys hear me say in the room, I will get out if I make 100%, or if the structure goes away. The structure is what is making the play an imbalance to begin with. And in the case of this one, let's say right now the structure in play for this play is all this call imbalance on the monthly expiration calls for PFE. Let's say I didn't check it, and nobody checked it, and they go ex-dividend tomorrow, and all of a sudden all that's gone, okay? If all that went away tomorrow because everybody exercised all this stuff and none of it showed in the volume, but all of a sudden the open interest was empty, then the structure behind the play went away. And I will try to grab the best I can on what's left and salvage it. So in this particular one, if tomorrow morning I got up and there was an ex-dividend, I didn't catch it, and all that got exercised and it went away and the structure was gone and this thing was trading at 8 cents or 10 cents, I would take my 8 cents and be gone, okay? Because the basis for the play to work no longer exists. And that happens, okay? It's also one of the reasons you get a lot of people that ask a couple different common questions that I get asked all the time. Well, Moto, look at the SPY imbalance, okay? Let me put SPY in there real quick. Everybody following me so far? Am I good? I put y'all to sleep on me. You bored? I don't know. I'm just chatting away here. When I get doing a class, I get pretty hardcore and just keep going. Y'all with me good? Okay. At least he is. Okay. I was going to get to that. Gigi's asking why I pick a particular strike. Okay. I play these with the room, but I also play these a little differently without the room. And oftentimes Lloyd will play these on the other side of the tracks with me. There's 3 ways to play this thing. You can look at this and say, okay, if I play an in-the-money strike, it's going to have a higher delta, and it's going to be painful if I'm wrong, because if it goes against me, I'm going to realize the pain much quicker right from the get-go. So because you're playing counter trend, if all this monthly open interest happened to be in the weekly, I would play counter trend and wouldn't think twice about it, because I know almost for a fact the thing's going to fix itself to some degree. So in that particular instance, I would play in the money. Lloyd always plays in the money. He wants to reap the benefits right away, okay? How do we play next? You play basically at the money, okay? Now, at the monies are going to pay you a lot better if they indeed do fix a bunch of this open interest imbalance. If you have this 33 strike and they drop it down to 32.50, okay, you're going to realize a 42-cent, probably with premium, a 50-cent profit, okay? Whereas if we buy this 33.50 for, how much is it, 33 cents, you'd see a little bit of profit. But typically, the further away you go, if it works, it pays better. Leonard oftentimes will play a little bit out of the money, okay? He's another moderator in here. He will go after, like, maybe, but he does his homework. He'll look at this trade, and Lloyd may say, okay, I like the structure behind the trade. I like the trade overall. I've done a little homework. I looked at the little toppy on the chart. You know, Leonard will come in and say it's at such and such ATR, or it's maxed out. And if it's maxed out, Lloyd's probably going to play it in the money. I will probably play in the money a little bit, but I won't tell the room. The stuff I put in the room is at the money, and it's usually cheaply, priced cheaply, and it allows everybody to come in here. I don't want to put options in the room that cost, $1 or $1.50 or $1.90, to where the minimum obligation for the room to get involved in a trade with me and the rest of the room is $150 to $200. Because what I could indirectly be doing is forcing people that want to follow me to go into trades that are outside of their risk tolerance. You know, for 30 to 40, or even, you know, you play it for $20, for 20, 30, $40, I feel like most people in the room can take on that kind of risk if they choose to, and not have to change how they do anything this weekend if it doesn't work. However, if I put them out there in their $150 or $200 trades, that could negatively, you know, affect some people in here, and I don't want to take that chance because I don't want to do that to the room as a moderator and a trader. And then there's the flip side to someone like Leonard that may go in here and say, I'm going to take the 3250 at a penny, because he may say there's so much, if, again, like I said, if all this open interest on the call side and the monthlies was on a weekly, this thing would fix itself. So if we were given the opportunity, he would jump all over that 3250 at a penny to 3 cents, probably fill for 2 cents, because the likelihood of it fixing goes up considerably if it has that much open interest in a weekly expiration. So there's the group of people in here that say, hey, I want to do, you know, 20 contracts at the 2 cents. And if it drops all the way back to 32, then I'm up 50 cents on an investment that I put 2 cents in. You know, you can do 20 contracts for the same 40 bucks. Then you're the one in the room that's going to get really paid well on this thing, because now you got, you know, 48 cents out of it, but you had 20 contracts. You know, so depending on what your commission costs, you know, in our case, mine and Lloyd, for the other guys, we have IB. A trade like that wouldn't cost us much. You know, so we could take on the risk of being out of the money a little bit, and not so much have to spend that much because of the commission. All right, did that answer your question? That wasn't the short version answer, was it? I hope it answered your question, though. So yes, there's three different levels you can play. You can play in the money. It'll pay right away if we're right. You can play at the money. It'll pay maybe sooner or later, eventually, hopefully by Friday, if we're right. And you can play out of the money if the structure is really strong, that the potential for the trade to work is really, you know, valid. If it's really there, you know, then you can go for a cheap play and do 20 contracts of a 32 or 32.50 for 2 cents and say, man, I got 40 bucks on this trade. There's a ton of open interest. If this thing fixes itself at all, these are going to, you know, pay big time. And they could. We've had some like that. So those are the three choices you have. Now, let me think here. What else haven't I covered here? I'm not going to get too much longer on y'all here. All right, so I've explained what an open interest is. I've explained where the imbalance comes from. I've explained my own personal rules. I've explained the importance of playing it small for a big win, not big for a bigger win to where you potentially take the loss on your big entry. And I've explained I don't use stops. I also explained, let me show you guys a couple other things. A lot of times you guys will pop off in the room or send me a PM and say, hey, Moto, look at that 28 strike. It's got, on the put side, it's got 25,243, and look at the 29. It has 30,975. What you need to understand is, theoretically, these huge open interest imbalances are not imbalances. It's interesting because I get a lot of people that send me a PM and say, hey, Moto, look at the imbalance on the 28 strike. That's not an imbalance because technically those are worthless. Until that strike goes, or that stock goes under 28 bucks, which maybe never will, those have no value to them. They have zero value. So those are, for the most part, worthless. And even the 32 strike right now has 14,345 on it. Those essentially are worthless. That's all time premium. There's no value in a 32 strike put. So they're basically worthless. So when you're seeing these high numbers outside of the grayed in area, so like on the put side, these are all in black, or on the call side, you see them in the black, they're basically worthless until the stock gets above them or under them, depending on which side you're on. So they are not creating an imbalance at all because there's no value to them. Okay, the imbalance is coming over on that call side because those do have in the money value. They have lots of value. $16 million we saw on the 29 and the 30 strike. That's where the imbalance comes from, not strikes that are on the put side that are worthless, but strikes on the call side that are in the money, some deep in the money. On the put side, the other thing we want to look at, and one of the things you got to weigh into the equation, and I already did this, On the 33 strike, we've got 20,608 contracts. So for this to come down like we need it, you've got to do the math on those and see if it creates a wall to actually stop the stock from wanting to go down, or if it's insignificant in the big picture here. In this case, it's 20,000 times 100, which would be 2 million, but it's only worth 20. It's not worth anything. You know, it'd be worth 23. It'd be worth 50 cents if it went down to 22.50. So we're talking, what I said was 3 million. So we're talking that one strike for this to go down to 32.50 and actually work for us for 50-cent profit against a 8-cent risk, puts those 20,608 in the money that's equivalent to about $1.5 million. So in the big picture, relative to the imbalance over on the call side, that $1.5 million is not going to serve as any kind of real wall. You understand what I'm saying? Now, when it goes down to 32, there's 14,345 that comes into the picture. It's not going to create a wall either at 32 yet. However, the 20,608 at that point is now going to be $1 in the money. So now the value of that one is $3 million. So these are things that you guys have to do the math on, and I've already done them prior to putting a trade in the room. Even down at 32, the amount that it will reduce the value of the call side is still considerably higher than the value it's going to bring in over on the put side on that 33 strike being $1 in the money. That will then be worth $2 million, $2 or $3 million. Big deal. We still got 30 million just on 2 strikes over on the call side. That at that point $1 cheaper may get reduced down to 26 million or 28 million. Who knows? But you follow what I'm saying there? So when you're looking at these, and I already did the homework on this one for you, but when you're finding your own or you're looking at them, look at the full equation. Look at the big picture. What's it going to bring into the equation for this thing to come down to 32.50 or 32 and make my 33 strike put actually work for me? In this case, we got weeklies. But we have to look at the monthlies because we're using the call OI as the basis for the trade. So we want to look at the put OI to see if there is a negative basis as to why it maybe won't work. And in this case, the open interest that will come into the equation is not enough to even come close to offsetting what's already in the equation on the call side. So in my book, I felt like it was insignificant in the big picture to get this thing to go down to like a 32.50 and get us a 50-cent win on an 8-cent entry. Contracts collected premium. Okay, that's another thing. I get a lot of people that say, why is there $25,243 on, you know what, do I have the bid and ask in here? Yes, I do. They ask, why is there $25,243? Well, that's a combination of multiple things, again, that we don't really know, but there's a couple things that I can put together and I can tell you there's probably some naked selling going on there. It doesn't pay much, you know, a penny or 2, 3 cents. You know, if you jump up to the 30, then it pays 5 or 7 cents. There's 18,000 there. Those could be naked sold, and what big players are doing is they're collecting that 7 cents. And if you take that 7 cents times 18,370 contracts times 100, you know, that's a pretty good premium to bring in if they know something or feel like they know something and they feel like it's not going to go below 30, it's going to stay above it. So they're selling those calls, the 28s, the 29s, or 30s. They're collecting that premium because they feel like that's going to go worthless. And the flip side is if they sell that premium, you know, they could get, if those go in the money for some reason, they could get those assigned to them. And they're saying, okay, on that 28, you know, strike, for you and I, we wouldn't be willing to put in a big amount or a large sum of money to be assigned a large sum of shares at 28 bucks to collect 2 cents. To bigger players, it's worth that to them. That's one thing that's going on. There's some naked selling going on. Let me show you another thing. Let's say you bought your share. Did I answer your question? Did that help at least? Everybody understand what I was saying there? where those out of the money numbers come from and how they could serve as walls, or they could actually be insignificant to the whole big picture, and how they're showing up and why. Okay. All right. Let's say you bought shares of PFE for 31 bucks a few days ago. I don't know what was trading at. Actually, it was $31 a few days ago. Let's say you bought 1,000 shares. Okay. So I'm not going to do the math from the standpoint of how much you spent and all that. But let's say you bought 1,000 shares of the stock at $31. The chart looked good. You were bullish, and you held on to your shares. Now, let's say today you decided, okay, I want to sell covered calls on my 1,000 shares of stock that I bought. Okay, so you can sell 10 contracts. In this case, they're selling a lot more than 10 contracts, because if you look at the 31 strike, there's 50,000 contracts. So let's say you're a big player. Let's say you're a big player and you bought 200,000 shares of the stock at 31 bucks a few days ago, and the chart was right and the market stayed bullish and the stock went up. So now you decide you want to sell covered calls. So if you look at the call side of that 31 strike, it's about $2, and let's use $2.30 to make it simple. If you sold the $2.30 call, that's the premium on the 31 strike, that's what you actually paid for your shares. You got one of two things that can happen here, okay? If it stays above 31 bucks and those stay in the money, you're going to get your 200,000 shares called away. What did you make? Because you got called away at a 31 strike and you bought them for 31 bucks, you made the $2.30 of the premium, okay? You were paid that much premium to let somebody, whoever, market makers, retail traders, take shares at $31 away from you. So how did you make your money? You made your money by collecting the $2.30 premium, and your shares got called away. Big players would then have that number show up in the open interest. Now, let's say it drops to 29 bucks, okay? Now you're down $2 in your underlying shares, okay? The call premium is going to go worthless if that's where it closes. Those are going to go to zero. So your down premium is going to go worthless if that's where it closes. Those are going to go to zero. So you're down $2 in your underlying shares, and your call premiums went worthless. So basically, you didn't get anything out of it. Okay. Now, if you flip over to the put side, if you're that same guy with his 200,000 shares, you can buy a 29 strike put for 2 or 3 cents, 4 cents. Okay. What that does for you is a couple things. If you are a put seller on that 30,000, you're willing to take an assignment on those at 29 bucks if they go in the money. If you're a put buyer, yes, I will. Let me finish up this class and then we'll look at a couple. If you're a put buyer, basically you're saying, okay, I will pay you the 3 cents premium for that 29 strike on my 200,000 shares that I buy or that I own. I will buy the equivalent amount of contracts for 3 cents. Because you're the buyer of that put, the option market, the market maker, the options exchange board is guaranteeing you 29 bucks for your shares. They're saying, if you pay us 3 cents, we will give you your $29 at expiration if this thing drops below that. Okay, so what you've done is you've bought yourself a $29 insurance policy. That's the least you can get for your shares for 3 cents. So at the end of the third week of May, no matter where it's trading, if it's below $21, it won't matter. You paid them 3 cents to give you $29 for your shares, even if it's 200,000 of them. So they will then take your shares away from you. So 29 bucks, if you bought that insurance, is the least you can lose. That's where that 30,975 is coming. Big players are buying themselves insurance that they can't lose below 29. Okay, flip back over to the call side. You bought your shares for 31, right? If it drops down to 29 bucks, you're down $2 on your shares, but you got paid $2.33 on your, or $2.30 premium on your covered calls, okay? So if you have 200,000 shares and you bought at 31 and it's trading at 29, your shares are worth $2 less. However, your covered calls still have a 30-cent value. So if it goes down to 29 bucks, remember, you bought the puts to be guaranteed that $29 price. So that is the least those can go down for you. They automatically have to take those because you paid the premium to have those taken at 29. So in the event at 31 bucks, that's what you paid. Say it dropped down to $29, say it dropped down to $24. If it drops down to 24 bucks, they have to give you $29 for them. You paid 3 cents for that. Okay? Your 31 covered calls that you sold, your 31 strike covered calls that you sold for $2.30 went worthless. Your shares are down thousands and thousands of dollars, but it doesn't matter because you're guaranteed 29 bucks for them, and you only take the risk from 31 down to the 29 where you bought that insurance, which is $2, and you still made 30 cents on your premium. So the big money can buy themselves insurance, and that's where you see all that huge number coming in on the 29 strike that has no value. Well, it has value to a stock owner because he's guaranteed that price. And if he bought his shares at 31 and it drops down to 25 bucks, he still gets his 29 for him because he paid a premium for that. And his base goes from $31 down to 29, which is $2, because that's the lowest he can lose on that thing. And he got paid $2.30 on his call premium, so he's still up 30 cents. So in essence, when you see these huge amounts like this, it's big money doing just that. They'll buy themselves an insurance policy against the other side or underlying shares that they own, and they will position it so that worst case scenario, they absolutely cannot lose on the trade. They still made their 30 cents. Does everybody catch that? That's a little deep. It's deeper than I wanted to go tonight. But did anybody catch that? And I can totally confuse y'all. Oh, nobody's even saying anything. They must be sound asleep now. Okay, did that make sense? A huge buyer with 200,000 shares, but 20,000 contracts or 2,000 contracts, whatever. That's what's building that huge imbalance on the 31 side, call side. He bought himself some insurance at 29 for 3 cents, so that's the least he can be, be hit on this thing. Is 31 down to 29 because he bought himself to pay the premium to be guaranteed 29 bucks. If it goes under 29, that's the lowest he can lose. But he got paid $2.33 for that, or 30 cents, and he's only down $2 on his shares. So this guy walked away with a net profit of 30 cents on 200,000 shares, or 20,000, 10,000, or 2,000 contracts, whatever. That's where these big numbers are coming from, okay? Now, hopefully y'all grasp that, because if you didn't get to be here tonight, I know this is a little long on this, but everybody that asks any questions about open interest, I try to cover everything in a class, whether it's a Thinkorswim platform class or a Thinkorswim scanner class or an IB class. I try to cover it all, because then when they ask, I just send them to the video and say, yeah, go watch my video. It covers it all. You will have, in fact, it was funny because I started to say your name. There was a member in here that was asking me some TOS questions. He said, I'm new to TOS. He said, I understand you understand it, the platform really well. Can I ask you some questions? And I said, yeah, sure, whatever. I wasn't busy. He started asking some questions, and about halfway into it, I stopped him. I said, do me a favor. Go watch both of my videos. It'll take 5 hours of your time. This is on a weekend. I said, devote 5 hours of your time to watching my videos. They're 2.5 hours long each. And I said, I will challenge you that Monday morning you won't have a question about my Thinkorswim if you absorb what I say in there. And he came back and he kind of laughed. He said, yeah, right, you're exactly right. He said, he answered every one of my questions. So that's important to me in these things, so that, we got a quick way out now. We can link it to you. We'll give you a link, give you a YouTube link. Here, go watch this. It'll answer all your questions. So that's what I try to accomplish with these things. So while it may be a little in depth and get boring for people that understand this stuff, it's not designed for you. It's designed for everybody else that has a million questions. All right, what else? Okay, now let's look at like SPY, okay? I get a lot of people that say, hey, Moto, look at SPY. Look at the imbalance on that thing. Yeah, there's open interest imbalances. There's huge ones. But what you want to pay attention to is what's going on in the volume, in the daily volume. We don't know what's going to happen with that daily volume. However, we know it's going to do one of two things. It's either going to decrease the open interest or it's going to increase the open interest. Okay? We won't know that until tomorrow. But what's going on here is we do know that there's 72,000. You know, I'll get people that'll send me a PM and they'll say, well, look at all the open interest on the call side of SPY. Well, there's a couple things. If you look at the put side of SPY, there's none. There's zero, you know, basically. So that's not even a factor. But if you look at the call side, there's a huge amount of open interest. But there's also a huge amount of daily option volume. And one of two things can happen. This can either get added to it or subtracted. We won't know until tomorrow. So on this 210 strike with a $72 or 72,656, there was 44,000 in volume. That may completely come off for all we know. And that open interest strike will go down to what, 28,000? But we could get up tomorrow and all of a sudden that strike only has 28,000 on it. The same thing could happen on tomorrow's trading, and all of a sudden by Friday, all this open interest could be completely gone. When you see us post in the room, they cleaned it, or they cleared it, or they washed it, what we're referring to is the potential for the open interest to be washed or cleared with the volume that is at hand for that day. So in this case, 44,000, if most of that comes off, that open interest is going to open up tomorrow at 28,000. So when I get somebody that tells me on a Tuesday or Monday, hey, Moto, look at all the open interest on the call side on SPY, there's a real good likelihood this is a go-to trader. Everybody goes to SPY and Apple. Some of these go-to traders that have this huge volume, you know, option volume, I got to clarify that, option volume, they wash these things up. They clean these open interests up. So when you present me with an open interest imbalance on a Monday or Tuesday, I won't take the entry, because when they have this much option volume, they could have that all washed up by Friday, and then the structure, which I told you about a little while ago, to the trade is no longer in place. So we lost our structure, and we allowed it to give it a whole week for the structure to go away, and we paid astronomical premium prices to watch them just totally destroy us. And you know, in $1.92, I'm not going to get the room in the trade that their minimum trade is 192 bucks, and then have the structure to the trade go away. It's not going to happen. But again, if you look over here on the put side, this is where the big players are playing. You know, they're naked selling this stuff, or they're buying themselves insurance in this 3 and 4 cent range. You know, 204. There's 204 strikers, 38,280. There's also some option traders that live in a pipe dream and base their theories on hopium, and they buy a 204 strike put for 3 cents and buy themselves 100 contracts and put 300 bucks on the line, thinking this is my golden egg, this is my payday this week. And 99% of the time those lose. Well, that's why the big players are selling those to you, because they lose, and they know that. You don't have probability in the money on this particular screen, but if I go to my other one here, it'll have probability in the money. And if you'll look at that 204, it has a 2.75% chance of going in the money. Well, who's playing that? You think that's being sold by someone that knows what's going on, or what do you think's going on there? The big players are selling that stuff because it only has less than a 3% chance of going in the money. Now, if you naked sell that stuff, you can get destroyed if they do go into money. That's no fun at all. Okay, or you can do a spread on it, but it doesn't pay well enough. You know, you can do a 204 and 205 if you're willing to do it for a penny with $1 at risk. You know, I'm not. But they're selling that stuff in a combination of the things that I just went through in here, of either naked puts, or you know, they're protecting shares. They want to be guaranteed. You know, maybe they bought their shares for 204 bucks, and they got 200,000 of them, and for 3 cents they can guarantee themselves $204 for their shares. And now they're, you know, up here selling, you know, 207, 208, 209 strike calls for $1.60, 249, and they're locking in premiums when the thing does come down a little bit. That's what's going on with all those. But if you'll notice again, a lot of those open interest strikes can get washed out with the volume. All right, let me look at it. Any questions? Did we cover everything on the open interest imbalance? I mean, y'all got that, right? I know Lloyd probably went to sleep. He's going to watch this later if he watches it at all. Let's put, let me get some more information. I'm going to drop this screen off. Let's look at BAC. I almost put y'all in BAC last week. And I didn't. And I'm pretty sure it was because of the open interest on the monthly. Let me look at the thing on a chart. All right, so what do we got here? Scroll up to the weeklies. All right, Bank of America. Okay, look at the 1450 call side. There was 76,000 on the table, and 55,000 volume came in today. Until tomorrow morning, we won't know what that did. If that gets added to the open interest, or if that were a bunch of people that cleared out whatever positions they had, whatever options trades they had, whatever. You know, we don't know. Maybe that'll clean that strike down to 21,000 or 25,000. So when you have stocks, and the other thing is look at the volume on this stock. I meant to mention that on the last one we looked at. The volume on this thing's $115 million in trading. You know, trade volume on the underlying itself. There, on that 1450 call, they got 76,000 open interest and 55,000. excuse me, on the volume. That could potentially leave $21,000. 21,000 contracts. 21,000 contracts times 100 is $2 million, but they're only 40 cents in the money. Okay, so 40 cents times $2 million is what? 800,000. So this big imbalance that you're looking at on this thing equates to $800,000 on that particular strike. It's nothing in the big picture of a stock that's trading 115 million in volume. They're not going to care about what's stuck in that imbalance there. Now, that makes sense. Now, if we go up to the monthlies, these I looked at last week. I almost got you on a trade, but it wouldn't have worked, so I'm glad I didn't. It was cheap. It was only like 5 or 6 cents. It was on a Thursday. I don't remember which pin it was. I think it might have been a 15 pin or something. But it still, even at 4 or 5 cents, it still didn't work. So I'm glad I didn't get y'all in it. But it was based on all this same stuff going on here. The 15 strike, again, do the math. Okay, we got a 233,000 on the 15 strike calls, which in theory is worthless until those go in the gray area. They have no value. Okay, so in theory, they could potentially maybe create a wall. 233,000 times 10 would be 2.3 million times 100 would be, that's 20 million in value, but they're only in the money by 7 cents. Oh, well, actually, they're in the money at all yet. So even if they were to go to 15 cents, they still don't have any value. If they went to 15.20, they'd have 20 cents value, and then $20 million, 20 cents value is what, $4 million bucks? Still small potatoes in the big picture of 115 million volume that the stock trades in. So would that actually create a wall? Not necessarily. It's not enough. I mean, if there's any kind of wall, that 139,408 could potentially slow it down a little bit. The 139,408 calls that are in the money on the 14 strike, those are 139, 1.3, 13 million times a buck. That was worth 13 million. Still not a lot. Not a big enough catalyst for them to go in there and clean that up. It's only worth $13 million. Same thing on the put side. You got 129,000 on that 15 strike, that are in the money by 7 cents. So take 129,000 times 100 contracts times 7 cents. That's 129, 12 million. It's $12 million, or 12 million times 7 cents doesn't add up to anything. Was it $100,000? So while the numbers look big, you look at that, you say, wow, 129,000 in the money on a 15 strike. if you do the math, take 129,000 times 100 times the actual value of it, which is only 3 cents, it's not worth anything. It's not a wall, it's not a magnet, it's nothing in the big picture, especially on a stock that has $115,000. So while I've explained the put side and the call side, as far as how to play it, I don't know that I could give you a good way to play that. The underlying volume so far is high enough that with what's in the money and no more relative value that it holds, the underlying volume is going to easily distract the direction the options are going to try to take this thing. Does that make sense? It just, if it went, okay, yeah, if it went deep, I mean, if it went up to, 1493, say it went up to like 17 bucks, not likely, 18 bucks, then you would have something. If all that call interest on the 14 and 15, and 13 strikes stayed there and it went deep in the money, now those option contracts would start to show real value against the actual trading price of the stock and the volume that the stock itself can trade. Because, when you start putting 233,000 contracts in the money by $3 or $4, now it means something. Right now, it doesn't mean anything. And on the call put side, 129,000 in the money by 7 cents doesn't mean anything. It holds no value in the big picture. So there's not enough here yet to make an educated call on which direction you would want to play this thing. I forgot I left that list up. Yeah, if you guys, JD's a smart one here. That market watch list on the left side there is an accumulation of the ticker symbols that it pulled for today that are going to have a little bit better volume. And hang on a second, I'm getting hot. I'm turn my fan on. I have it. Hang on just a second here. There we go. Uh-oh. Didn't need to do anything. Hang on just a second here. Turn on my fan systems that cool my computers. That'll cool me too. Hang on. I can do everything from the computer itself. All right, I turned on my cooling system for my computers and I'm using it for myself. All right, hang on. I'm going to slide this one back over. Leave myself just enough room to get that other one to come up. And then I'm going to, all right, from the standpoint of the class, any questions? I mean, did it clarify a bunch of stuff for you? Hopefully it did. What I'm going to do here is I don't want to spend a lot of time on this, but we'll pick out a few examples if you guys pick it. I've got to change that little thing to red so that it synchronizes itself with my actual options chain, and then I'm going to pull up the more simplified one to read and put it back up there again. And then we'll knock out a couple of these real quick and see if we can find something. Some of these I already looked at. So all I have to do here, the way I have this going, is click on one of the ticker symbols on the left side here, and it's synchronized to my options chain. I put the simpler options chain without the theta deltas and all that stuff up there, and so it's just showing volume open interest. So for tonight, I could quickly go through these and see what we find. So if the first one I check on, it's monthlies. It's monthly expiration. Yeah, there's a 16,647 on that 15 strike. Those are 81 cents in the money. So you got to do the math. On one like this, you got 6,400 over here on a 15 strike put side. That goes in the money for them to drop this thing. Then we're going to start to get up against the 10,000. So when you have one that's trading at 14, 15 bucks, and you're moving a dollar around the strikes, look at the underlying volume on this thing. It's 1.2 million volume traded. These are the kind I like to find. Okay, so what if I was going to trade this? I wouldn't give it to the room until this thing. I haven't even looked at a chart. I haven't looked at anything on this thing. But what I would like to see is at 1581, the 15s are trading at 28 cents. If this thing were to go up to, say, 17 bucks, these are monthly expirations, so you got 30 days yet. So what I would do is I would right-click on this thing, and I could set an alert if I wanted to. And I would set the alert and put a verbal, write-up in there that says, okay, ACAS, when the stock gets to 1720, ACAS, when the stock gets to 1720, that will put the 16,647 deeper in the money. It will put the 17,757 on the 17 strike in the money. I'll note that in there, and then I'll say it will take out the 6,000 and 10,000 completely out of the picture on the 14s and 15s. And then I will put in there, I would like to see if I could collect the 16 strike up on the put side for about 25 cents. Okay? So if all that went into play correctly, this thing went to 18 bucks, and it brought the left side calls deep in the money, took the right side puts completely out of the money, and we could get a 16 strike, 17 strike for 25, 30 cents. That's when I would, once the alert goes off, and it alerts me to the write-up that I gave this particular one, that's when I'll look at it, make sure everything's in place still, the structure's in place, it's topped out on a chart, it's maxed out, and boom, I throw it in the room. That's when you guys get these. When I've already done the homework and it gets to where it needs to be and the alert goes off, then boom, they get thrown in the room. And hopefully after tonight and after everybody watches this video, we don't get bombarded with questions of why? Why did you do this? Why? Okay, because I should have covered all of that tonight. So when I get an alert and I toss this one in the room and say, hey, guys, ACAS, try to get the 16 strike for 28 cents or 30 if that's where it's trading. Let's say it's trading there. I want all you guys to be able to have a visual concept of exactly why I looked at this trade and considered it. Okay, we should be able to eliminate all of that. You guys should be able to look at it and say, oh, that's exactly why he took it. It's got a 16,000, that's assuming they stay. It's got 16,000 on the 15 strike, got 17,000 on the 17 strike. Those are all in the money. It could easily go down to that 15 strike. We're going to buy the 16 for 20 cents or 25 cents. It goes down to 15. It's $1 return. Risk reward is good. Boom. You take it all on your own because you're capable of understanding it going forward from tonight. This one's not ready. It did show up, and it's got an imbalance, but it's not ready yet. That one doesn't have it yet. And some of those that you don't see it, I got to go deeper than 26 strikes to find it. That's how I found the Disney one. It came up and it didn't show an actual imbalance, and I was like, well, my scanner found it, so there's got to be an imbalance somewhere. So last week I stretched it out from 26 strikes to all of them, and that's how I found that 110 strike put that had 35,000 contracts on it. Let me look at a couple of these that I don't know what they're going to look like already. Yeah, see this one? You see these numbers that are showing up that are giving me these are meeting my criteria. There's 5,700 on this one on the 2250. That's bringing this one in. I don't like it because there's no option volume, so it's not trading good. I think we traded this one before, CBS. Let's see what we got here. If it brings us anything on nothing on the weeklies, so there's nothing there on the weeklies. Not much on not a whole lot on the monthly either. I'd have to stretch that one further to find it. I don't want to do that while we're recording a class. I just want to pop through a few of them here real quick so you guys can see them. That one's on the monthly. In fact, I'm only going to see if we can find a weekly real quick. I know which ones are the monthly ones. There's a weekly, but it's not imbalanced enough. That one's on the monthlies. And see, like I told you, it's hard to find these imbalances on a week. But boy, when we do, we get a home run. See if this one's got one. No, those are monthlies. Hey, this one came back in again, MAS. Must have a deeper stride. Oh, it's got 3,200 over here on the, it's not in the money though. Let me show you. See, these are going to be the oddball stocks, the ones that are more likely to work. If I go in here and change this to a open interest weekly pin number 2, it's going to loosen it up a little bit. See how that gave us a whole bunch more? I'll still go through this because you're going to find ones that have indeed have a, a true imbalance. That's how we found one several months ago on BABA, BABA. It had a legitimate imbalance, and they fixed it. So even the big playing stocks can have them. Here, if we look at this one, this one, who can tell me if that's balanced or imbalanced? Let's see who's paying attention here. With just a quick look at it without doing the math. No one? Geez, I might have hang this up then if I put y'all asleep. Is this balanced or imbalanced? Don't be shy. Is there an imbalance here? Geez, if I could talk for 2 hours, then somebody ought to be able to give me an answer at least. No, it's balanced. Why? Because trading it, oh, that's a nice try. That's okay. Let me show you why it's balanced by just looking quickly at it. Without doing the math, you could be right. But where I drew my blue lines here, we're trading at 81 bucks. It's got 15,000 bucks. That's $1 in the money, and it's got 12,000, 15,000 contracts. It's got 12,000 contracts that are $3.50 in the money. The flip side is it's got 21,000 contracts over here that are $4 in the money, and 16,000 that are about 50 in the money. So from a balanced versus imbalanced standpoint, it's relatively balanced. If I were to actually do the complete math on it, it's going to lean over to the put side, I can tell, because this 21,000 is a little bit deeper in the money relative to where the 12,350 calls on the 7750 is. So, at first glance, it's balanced enough for a stock that trades with this kind of volume. It's probably imbalanced slightly to the put side, to where this 21,000 is weighing a little bit heavier and could potentially bring this thing up. However, these at-the-money strikes on the monthlies are so doggone full of premium. You need a big move to get this thing to work. If you're buying an 81 strike, call with it wanting it to go up and fix that put side at $3.30. You need a huge move to get that to work, and it's not going to come from a options imbalance, not yet anyway. But thank you, Howard, for answering. Right, wrong, you were close to right, because if you did the math, you'd probably be right in that it's imbalanced over to the put side. At first look, it looks reasonably balanced. But thank you for the answer. At least I know someone's paying attention. I always get asked, hey, what about Facebook? What about Facebook? Okay, let's look at Facebook. I would be willing to bet a lot of the strikes are washed. Yeah, they are. Look at the weeklies here on Facebook. On the 112s, we got an open interest on the call side of 16,000, 19,000 volume, washed up. 11,000 on the open interest, 11,755 on the 111s, washed up. Everything's washed up. We got a little bit more on the put side on that one strike of 113. So maybe extra buyers came in today over and above the open interest that was already in there, that are people that want to actually play the put side, thinking maybe it's going to go down a little bit. They're playing with a little higher delta. This one doesn't show the delta, but they're playing a little higher delta so that if they're right, it'll move better for them and gather up some profits quicker. But for the most part, if you look at this thing, it's pretty cleaned up. If not by today, got a few strikes there left that are still in the money where they're off balance, but they'll get cleaned up tomorrow. As far as the monthlies, it's got an imbalance, but it's not a huge one. It's relative to the volume of the stock itself. The 64.99, 6,090, and 21,000. Yes, that's an imbalance on the call side relative to the amounts over on the put side. But the premiums are stacked full of extrinsic value. So, it could be brutal trying to be right on the, be on the right side of this thing. If you're saying, okay, the call side is heavy, I'm going to play puts. Well, if you're playing at the money put, you're going to pay $4.80 for it. there's a lot can happen where that thing can get pretty miserably beat up before you get a win. You know, based on an imbalance. That makes sense? All right. That's it. I'm done. I don't know how long it was, a couple hours. I try to keep them around a couple hours. Most importantly, I try to cover everything. So all I have to do is give you a link when you ask me. So I'm going to cut this thing loose. Where's Loie? Loie, you still awake? I gotta have you. Oh, I can stop the recording myself. Actually, it was an hour and 39 minutes. That wasn't bad. Hour and 39 minutes. Y'all can sit through that.